Good morning, good afternoon, good evening. As we speak to our viewers around the world, welcome to the RVW webcast. We are delighted, honored, privileged, humbled to have Professor Jeremy Siegel with us today. The history of RVW is an interesting one. I will tell you about that in just a moment, and the formative ideas and the great responsibility that Professor Siegel has for influencing me in those early years to build a wealth management business that really is a wealth optimization system. We sit on the shoulders of giants that enables us to see the furthest, and Professor Siegel is one of the giants on whose shoulders we proudly sit. He is a thinker, a scientist in the field of economics who has pretty much brought a dramatically new way to view equities to the world, and he has many disciples, but he is clearly the leader of a view of markets that's fundamentally different from others, particularly with respect to risk and returns and volatility and the magic of long-term equity investing, which has impacted me personally and my family's portfolio. And of course, each of you who is a client benefits directly from the wisdom, the insights, and the funds that have been inspired by Professor Siegel, including the Wisdom Tree family, of which he is the original strategist and thinker, and provided the inspiration for that family of funds, which we employ in our portfolios on a very regular basis. It's a pleasure to introduce Professor Siegel. If you could come onto the screen now, Professor, I would like to express my thanks to you and tell you about how far back we go. I told you that I would have a surprise for you. Then if you could see this.
Oh, my goodness.
Do you remember that?
Oh, wow. Yes.
Okay.
Well, Rittenhouse originally sponsored my book at the very beginning. They were the first ones. So this is more than 30 years ago.
That is true. That's how far back we go. I told you. Now I'm going to show you the chart. It's very interesting. You will know that this chart has remained the same for all that time. And if we substituted any 15 years, we would have the same chart.
Yeah.
Is that fair to say?
Very close to the exactly the same.
Am I worthy disciple of you, Professor?
You are. You got the main message there, Selwyn.
There you go.
No doubt about that.
And I could flip through. I've got all your charts from all those days ago, all those years ago. Here it is. This is in my permanent treasury. And that lecture in 1996 started me thinking about equities in a whole different way, truly. And so I'm extremely grateful to you for that inspiration, which prompted me to look at what we were doing at the time, which was to be referring out clients for wealth to be managed by the Wall Street machine, which I would not want to tell you what I think of them publicly, except to say that we eschew them, their values, their conflicts of interest, their self-serving mode of operation, and all the other stuff that I'm sure you know very well, probably much better than me. So moving away from Wall Street towards what I would call the world of science, data, objectivity, and becoming true fiduciaries, which is not a word that appears much in the Wall Street region, as you well know, enabled us to build RVW on a solid basis. So with that, it's my pleasure to introduce you to the RVW family, to invite you to share your thoughts on a host of topics covering current events, markets, crypto, and whatever else you think is relevant, the Powell issues that are prominent currently, interest rates, whatever comes that you think would be of interest to people who are fascinated by markets, by the economy, by what's going on in the world, and are eager to absorb your wisdom and insights. I'm honored to have you with us, and I'm glad to give you the screen.
Well, thank you, Selwyn. I think I should talk a little bit about some of my original research, which has attracted Selwyn to my thinking. Was in the late 1980s. Actually, I was asked with a colleague of mine to do some historical research on on equities, and I expanded that. I went all the way back to the beginning of the 19th century, and I sort of asked the question, what kind of equity returns have we had since, over, at that time it was almost 200 years. And I did it for bonds, treasury bills, gold, the value of the dollar, the major classes of financial assets. And the I think the striking thing that even I just did not know is when I plotted the real return, the after inflation rate return on stocks. Even though it was the most volatile asset class in the short run, it was the most stable asset class in the long run. And I think that's what you meant by saying it's the same graph. The return on equities, compound annual return after inflation, now this is dividends plus capital gains after inflation, and compound return has been really between 6 and 7% through all the periods. I mean, there are some decades that are, worse, some decades that are better. You don't get it every time. But once you get out to 20 or 30 years, 6 to 7% is almost 90% of the observations fall right into that category. And that wasn't true with bonds. And so in many ways, stocks in a longer period of time were less volatile than bonds, which of course is against the established wisdom, which looks only at the very short term, where stocks are more volatile. But I said, if you're a long-term investor, then you got to look at a very different set of risk-return trade-offs than you do if you're just a very short-term trader. And I think that message that was given, I mean, it resonated. I didn't have much advertising for it. I was a really new first-time author, yet it sort of broke out onto the scene and got great reviews in Business Week and other major. And then I got invited to a lot of talks, and I think that has done. We now are in the 6th edition of it. First edition 1994. In the 6th, we've sold almost 500,000 copies of that. And it was beyond my dream to be able to do that. So let me tell you a little bit about what I think today. And so when you can come on, I mean, I'll discuss a few major things, and you can move me along. I'm optimistic right now. Now, with the war going on and oil prices, surging to highs, you could ask why. And the answer is the AI boom. I am an AI optimist, artificial intelligence optimist. I've written an article actually that is posted on our Wisdom Tree site that talks about the gains that can be made, and not just profits of firms, but higher productivity that leads to higher wages, that leads to higher incomes for people. People are too much substitute. People don't have to work to do these things. But on the other time, they don't see that it's going to earn a lot of more income for a lot more people. And that is going to more than offset any job losses. In fact, the demands from these people, I talk about an experiment, and I won't go through it here, about how, if we double productivity, we would add at least $16 trillion to our GDP, and it would open up industries, expand current leisure time activities. People could afford things they could never afford before. American dreams will be realized in ways that have not been before. I'm very, very optimistic about that. And of course, that is one of the factors driving our economy today. The other thing, of course, is that thank goodness we are not as impacted by oil as we used to be. We are a net oil exporter. We were not in the 1970s. So as a result, there certainly consumers are going to be paying a little more, but the producers and the workers and everyone involved in the energy distribution industry, of which there's hundreds of thousands, are actually going to increase their income. And by the way, natural gas, which are now become our major source, has actually gotten cheaper. because of the Straits of Hormuz being actually closed, we are not exporting as much, and natural gas is actually getting cheap, which offsets a lot of the rise in gasoline and oil prices. Secondly, of course, we're going to have more spending, military spending. We have to replace the military hardware that we've used and the missiles that we've used. And that is another stimulus. And also a stimulus, I think, when I look at some of the deposit data and money supply data, I do see that the Federal Reserve is not being restrictive right now. And let's go to that Federal Reserve issue. I was on 2 weeks ago, kind of shocked people. I was on CNBC, which I appear almost once a week on, and I kind of shocked everyone by saying, with a slight tilt, I think the next move is going to be up on interest rates, not down, because the economy just looks really strong to me, and inflation is certainly going to be a factor. I don't see inflation anything like what we had in 2020 or anything like that, but I see a bump, and that's going to prevent the Federal Reserve actually from moving on. Clearly, we now have cleared Kevin Warsh to be the new chair. That's he's a very well qualified individual, and I think the June meeting is going to be one of the most interesting meetings that the Fed ever had, because certainly he was Trump's pick to lower interest rates, and I don't know if he's going to be confronted with any data that is going to support that move. But don't forget, that's almost 2 months away. So there's a lot can happen. A lot can happen with the war, and a lot can happen everywhere else. So it's hard to really even prejudge that. He will make some changes. One maybe in projections, how the Fed projects into the future. He may go back to only 4 press conferences a year from the current 8 that was expanded by Jay Powell. Jay Powell now says, I'll stay on. I think he only wants to stay on until he is totally and completely cleared of any of the charges launched by the Trump administration. Then I think he will leave. But in the meantime, he will stay on. He doesn't want to dominate Warsh. He wants to just be a governor with an independent mind there. But clearly, given that he was chairman for 8 years, his views are certainly going to be important. Remember, Warsh is only 1 vote, no veto power. The voting group is 12 members. Warsh has to convince another 6 members to pass any change in interest rates. And given what I saw coming out of the meeting that we yesterday, actually, I don't think that, given what we see now, that's going to be easy to say let's lower them. As you know, we had 3 dissents in favor of saying that inflation was at least big a risk as a slowdown in the economy. And that was a very unusual move. It was sort of like, I'm putting down my stand on what actually is going to happen. I think that we're not going to see mammoth changes in interest rate setting. He will be alert that if AI lowers prices through rising productivity, he will let that growth go and will not tighten as much. This is often described as what happened to Alan Greenspan when he judged as the internet was becoming more and more used and driving down prices at the end of the 1990s. He did not tighten either. But he would have to see the evidence of that, and there was a little inflation. So, again, Warsh was on the Fed for 8 years. He's a very well-informed economist. I think it was a very good choice of President Trump on that score. What kind of returns do I expect? I think In the short run, we've got a lot of momentum going for us. The only thing that could be, set the momentum forward on the market off would be a big rise in oil prices to maybe 150, 160, which is not impossible. And then I think you're going to have a correction. A correction is defined as a 10% decline in stock prices. But I think if it stays in the 90 to 100 zone, we can deal with that. That is actually historically relative to inflation not that high. And I think the economy can move forward positively from that, and that this would be a good year for stock returns. When I look much further down, 5, 10 years, I don't quite see the 6 to 7% after inflation. I see more 5 to 6% after inflation annual return on stocks. And that's because price earnings ratios are somewhat elevated, not above average. I believe the new average PE is 20, and we're very close to 20 on a forward basis, 21 maybe. So we're not really very overvalued. But those 20 PEs do generally mean that it's likely that we might not get quite as high as a historical return. Notice that is still much higher than the return that we get in bonds. The bond return after inflation, if you go into tips, is less than 2%. So, compared to with 5 to 6, you're really at about a third of that level. We are, I'm for long-term investors, I am very, very, pro equities and diversified. Now, let me talk about what equities for a little minute, and then maybe someone can come on and, prompt me for some more questions, any questions that he may, want to ask. I do like value stocks, but we're in a very special period. We've never seen a group, Mag 7, and I will exclude Tesla. Tesla doesn't really have the earnings. It's all option on what Musk can do. The others have earnings, and they're growing at extraordinary rates. And they have price earnings ratios that are not crazy by any means. They're well above average, but given their growth rates, not crazy. I am not ready to say, don't shun those groups of stocks. I think that those groups of stocks have the chance of doing better. That doesn't guarantee they will. But I'm not now saying you got to underweight those. Those are crazy. It's not like the internet at all of 2000. That's very important for you to know. We are not in a bubble. I'm not saying that a bubble is impossible to get to, but we are nowhere near it now. So I think that that's important. As far as international stocks, they're much more reasonably valued. They don't need the growth. Most of the rest of the world is selling for around 15 price earnings ratio, which is a good return of 6 to 6.5% after inflation. So again, once you get down to the mid-teens, you don't need much growth. If you just survive and keep on producing what you're going to produce. When you get into the 20s, you need the growth. And that's why we see, these were good earnings that we had on 4 of this Mag 7 last night. But what do we see? I think 3 out of the 4 are down today. Why? Because the bar is so high. Once you get down to 15, 14 times earnings, you don't need to make. If you just match the bar, people are happy, and it's fine. It's the old saying. When you ask me, is this a good company to invest in, or is this a good company? It may be a great company, but the price might be too high. Company B may not be such a good company, but given how low the price is, I would go into it. So you got to, in price, let me end my first part of my presentation, and then we'll go to question. In the short run, if you're an investor and a trader, you do, in fact, chase earnings, try to beat what, the other investors are doing. But in the long run, valuation, or what price you buy it at, is the key to successful long-term investing. So, Selwyn, I will go back to you for if you have any follow-ups.
Inspiring to hear your words of wisdom, and we're very grateful to you for that. Just a couple of kind of more general questions, because I think your philosophy is very much embraced by us, and we are long-term mega bulls in your mold, and thank God our portfolios have done really, really well. Observing those, we don't do market timing or stock picking; those overwhelmingly fail. And the point that I would just emphasize in your comparison with equities and bonds, when you looked at those TIPS returns of 2% after inflation, that's before income tax.
Yes,
And when
they
you
are
look
very
at the
badly taxed. So, I mean,
correct,
they're terrible in a taxable account. I
correct.
absolutely agree. Yeah.
So the bottom line with bonds is in most cases you're actually going backwards, especially if you live in California and you're in taxables. And of course, if you're in tax freeze, they're paying you even less. So yeah, we're totally there. Bonds are generally, bonds and equities actually move in opposite timeframes. They're really good in the short run, and they're terrible in the long run. Equities work the other way. That's like a giant egg, right? So it's all a question of time frame. I want to just get out of just pure stock market for a little bit, because I want to tap your wisdom in other areas. We're hearing a lot about the K-shaped economy. We're hearing a lot about that. And of course, as you alluded to in your presentation, a lot of wealth is going to be created by AI. And obviously, it's not just going to be the AI generators per se. As AI integrates into every aspect of society, life itself, and the economy as a whole, all of efficiency will go. And I think that's what you were alluding to in your presentation. The question is, how are those goodies shared by society? And how are we going to make sure that if people don't have jobs, which they may not have, what kind of a society will we end up with? And are we going to have to start paying people not to work, which you might argue is already happening in one form or another? But how do you see society evolving since you ventured out, into the longer term? How do you see that?
Well, what's interesting is actually low wage workers have not lost ground on income side relative to high wage. What has happened over the last 5-10 years is that the skewness on wealth owners. If you are fortunate enough to have owned your home and a stock portfolio, you're doing well. Your wealth is high. And if you have not, and you're a renter, and don't forget, I mean, 2/3 of Americans are owners, 1/3 are renters. You are falling behind. You're not building up equities in their home, and unless you have been, having a savings IRA plan where you accumulate equities, you may not be doing there. So the biggest dispersion is in wealth, not in income, actually. The income, I mean, we really, um, uh, there's a big demand for low income workers, actually, and their wages are pretty good, and there's a lot of. But again, is that enough? People ask, yes, but is that enough to buy a house today? No, because house prices have gone very, very high. So, if you saw the American dream, owning your own home, and we could talk about why house prices are so high. There's a number of reasons, a lot to do with regulations and NIMBYism, if you want to say but lack of technology in building homes. Then it becomes more difficult. But on the wage side, we're doing well. So the question really is, I mean, a lot of people spend out of their wealth. I mean, the wealthy people, we're the most charitable country in the world. A lot of people with trust, to give away to charities. They fund a lot of things, and millions of people are employed, because of the billionaires. I'm not one of the billionaires at all, but I mean, the type of industry and the type of work they generate is very, very high. So in that sense, you do get a flow down. Now, people say it's a trickle down. It's not a flow down, and people are talking about that. But the truth of the matter is there are opportunities out there. I mean, look, at unemployment rate is still extraordinarily low. I mean, we just got this morning, and was shocking even to me, a new jobless claims. It comes out every week. It's a very important indicator. The lowest in over 50 years number of people laid off. Now that doesn't sound like an AI apocalypse, like, oh my God, all these jobs are disappearing. There, it isn't. I mean, a 50-year low, and this is not even correcting for the growth of the population over that period. 187,000 is something that we have not seen since the 1960s. So, and the unemployment rate, I mean, we have seen lower ones, but 4.3, 4.2, these are very low numbers. So we are not really seeing layoffs and massive claims for unemployment or anything like that. I think a lot of it has to do with training and education, and I think we are falling short on that on the secondary level. Very honestly, I've been privileged. I'm teaching the best. I teach the best at the best universities, but I do know that we have, and it's when you go, earlier than in university, in secondary school, etc., people are not getting trained properly. More and more people need. I think too many people go in universities actually, and think that's the only way. And really, there's so many jobs to train for that don't need a university. And I think we overemphasize, oh, you got a degree from the university. So it shows a certain amount of discipline. We need to refocus it. And a lot of people learning AI, I mean, you don't really, how to use AI, you don't need a university really to do that. There could be AI training centers. You're young and you have and you don't have to be a computer genius. You have any facility with computers, and you get a training about how to use AI, I guarantee you'll be snapped up for a job in 10 seconds. It's the older generation, a lot of the older workers in their 50s, 60s, and later, they need to retrain because they weren't brought up with it. But the younger people, I think, are definitely being right. So I'm not pessimistic about this sort of K-shape. I understand where again the distribution of wealth is more skewed, but the distribution of income, especially once you actually add in benefits, a lot of people don't. They look at wages. You got to add in. There are food benefits, food stamp, housing benefits, medical benefits, etc., and so on. When you add those, you do not really get a skewing of the distribution of income.
That's wonderful. Well, I'm very grateful for the time you gave us. I'm not going to take further advantage. I know you're a busy man. Very grateful for this time. Thank you for your wisdom and your insights. Have a wonderful spring and summer. And let's hope that all the optimism that you've shared comes to pass. And hopefully we'll see you again in the not too distant future. Thank you very much.
Thank you, Selwyn. It's been a joy.
Thank you very much.